Welcome back. Today, we are cracking open one of the most powerful and, let's be honest, most controversial tools in finance, the leveraged buyout, or LBO. You see it in the headlines all the time, building empires and sometimes breaking them. So how does it actually work?
Well, it all kicks off with this wild question. How in the world do you buy a billion-dollar company when you don't have $1 billion? It sounds impossible, right? But that's the central magic trick of an LBO.
And here's the secret. An LBO is when you buy a company using a massive amount of borrowed money. That's the leverage part. And here's the kicker. The assets of the very company you're buying are often used as the collateral to get the loans in the first place. So here's our game plan for today. We're going to cover what an LBO is and who the key players are. Then we'll dive into the real secret sauce, the power of leverage. After that, we'll look at what makes a company the perfect target, and finally, the end game, how everyone gets paid. All right, so who's actually out there making these massive deals happen? In the world of buying and selling companies, you've basically got two types of buyers. And believe me, they are playing completely different sports. On one side, you have your strategic acquirers. You can think of these as other companies in the same business. Their goal is long-term. They're looking for synergy, making the whole greater than the sum of its parts. But on the other side, you have the stars of our show today, financial sponsors. These are your private equity firms. They are not in it for forever. They have a very clear timeline, just a few years, and they are laser-focused on one thing, getting the absolute best financial return possible.
And this quote right here, it just nails their entire mindset. A financial sponsor is an investor, pure and simple. The mission is to buy low, make the company more valuable, and then sell high, all within a pretty tight window. And to pull that off, they use their favorite tool.
Which brings us right to the heart of the LBO, leverage. This is the secret sauce. This is what can turn a good investment into an absolutely incredible one. If you look at a typical LBO, the way it's paid for is, well, it's pretty lopsided. The private equity firm, the sponsor, might only put up about 20% of the price with their own money, their equity. And the other 80%, that is all debt. It's all borrowed from banks and other lenders. So why do this? Well, the huge advantage is pretty obvious. Using all that debt means the sponsor has to put up way less of their own cash. It's kind of like buying a house with a small down payment. You get control of the whole asset, but you have less of your own skin in the game, which frees up your capital to do other deals. Sounds like a sweet deal, doesn't it? But there's got to be a catch. This is a high-wire act, for sure. So how does all this leverage also crank up the risk to terrifying levels? Okay, check this out. Let's imagine two identical companies, and their earnings drop by 20%. The company with no debt, its net income also drops by 20%. Makes sense, right? But the company with debt? That's a totally different story. That company still has to make its massive interest payment no matter what. So that same 20% dip in earnings causes its net income to crash by a whopping 34%. Leverage is a double-edged sword. It supercharges your gains on the way up, but it can absolutely wipe you out on the way down. So given that insane level of risk, sponsors can't just slap this strategy on any old company. No way. They have a very specific checklist they run through to find the perfect LBO target. And here's that checklist. Number 1 with a bullet is strong, consistent cash flow. That is non-negotiable because you got to have cash to pay down all that debt. After that, they're looking for a company with a strong position in its market, a place where they can come in and make things more efficient, and a business that doesn't need a ton of new investment. And finally, having a lot of solid assets helps secure the loans to begin with. Okay, so let's fast forward. The sponsor has run the company for a few years. They've paid down a bunch of debt. Now what? What's the end game? How do they finally cash out and figure out if the whole gamble paid off? It really all boils down to two little acronyms that pretty much rule the private equity world. IRR, that's the internal rate of return, and MOIC, which is the multiple on invested capital. Here's the difference. IRR is all about the speed of your return. Think of it like a yearly growth rate. A good target is usually in the 15 to 20% range. MOIC, on the other hand, is way simpler. It's about the sheer size of your profit. It doesn't care if it took 3 years or 7 years. It just asks one question. How many times over did I get my original investment back?
And to make MOIC super clear, let's just throw a number out there. This is a common benchmark for a really successful private equity deal.
A 3 by MOIC means exactly what it sounds like. For every $1 the sponsor put in at the beginning, they got $3 back at the end. It is a beautifully simple and powerful way to measure how well you did.
So how do they actually get that cash in hand? A few main ways. The most common are either selling the business to another company or taking it public with an IPO. Then there's a trickier move called a dividend recapitalization. That's where they make the company borrow more money just to pay a huge one-time dividend back to them. It's a way to get some cash out early. And that last one, bolt-on acquisitions, that's actually a growth strategy, not an exit. It's when they use their company to buy up smaller competitors, making it a much bigger, more valuable prize for when they do finally sell.
So when you strip it all down, an LBO isn't just buying a company. It's a high-stakes financial machine running on this delicate balance of huge debt and the potential for huge returns. The next time you see a headline about a private equity firm snapping up some household name, you'll know exactly what's going on behind the scenes. You'll know to ask, just how much risk are they taking? Can that company's cash flow really handle it? And what's this company going to look like in 5 years when they're ready to cash out?